Hey, good morning, everybody, and welcome to this Tuesday, February 27th, 2024 edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes or so as we prepare for the trading day ahead. Well, we've got futures somewhat pointing to the upside. We got the Dow futures down just a little bit. Last look, down about 20 points, which was just about 5/100ths of 1%. So not much there. S&P up 5 points, which is about 1/10 of 1%. Nasdaq futures up 43. That's about 1/4 of 1%. And then the biggest one of all is actually the IWM. That one is jumping up almost a full percentage point this morning. So the IWM back up to 203. And remember, we'll take a look at this in a little bit, but remember that the IWM had formed a cup after its uptrend, had a really nice cup, pulled back, put a handle in, and now it's about $2 away from breaking out above the top of that cup. So watch that 205 level, break out above that 205 level. I don't remember where the bottom of the cup is, but we'll take a look at the measurement. I think it was down around 186 or so. But we can then measure up probably close to another 20 points or so based on that pattern and potential breakout. So that would be one thing certainly to watch. The XLY also trying to break out today, so that would be another. But we'll be looking at those as we go through some of the action from yesterday. Let me go ahead and start with the recap from Monday. So we had the Dow Jones Industrial Average finish down 62 points. The S&P 500 down 19. Not seeing those charts up just yet. There we go. So the Dow down 62, S&P 500 down 19, Nasdaq down 4, which was relatively flat. So those three, at least on a relative basis, Nasdaq showing a little bit of leadership there. Mid caps down 3.5 points, which was roughly a little more than 1/10 of 1%. IWM actually finished up yesterday, so it was the only index finishing in positive territory. It was up just a little more than 1 point. IWM closing above the 201 level. Transports down 78 points, which is about 1/2 of 1%. But transports had done pretty well last week, gotten back some of those losses that we had seen previously. So we're still holding the 15.2 level. We got rising lows in place here on the transports. So even though we had a down day, we were in a position to absorb it. And so we'll just kind of see whether or not we can continue to hold 15.2 to the downside. Meanwhile, to the upside, about 16.2 is where we'd be looking for another breakout in the transports. Looking at the sectors, we had energy trying to make a breakout here. And as you look at this chart coming down, you can see a series of lower lows. And the last one was just barely below the prior low. So that was the January low versus December. Almost equal lows, but slightly lower. The high in between those was at the beginning of the year when we got up to about 87 or so on the XLE. We closed yesterday at 86.26. So we're right there. We're right on the cusp of not only making a high above a recent high, but it actually would end this pattern, this recent pattern of lower lows and lower highs. Now, I've spent plenty of time in the past talking about the XLE and how, to me, it doesn't trade according to plan, if you will, based on the way a lot of the other sectors and major indices do in terms of following technical analysis. So even a breakout, you got to be somewhat cautious about just like I said last month, we had a breakdown. It looked like things were horrible. The PPO was rolling back over, pointing straight down from that center line test. And then what happened? The breakdown was gone, and now all of a sudden we're on, talking about a breakout. So that's just been my history with energy. I'm not a big fan of following technicals on energy because of that. I don't trust them. So it's one of the reasons why I don't trade energy stocks for the most part. There's just too much going on in different parts of the world that impact these energy names. And it's hard enough keeping up with what's going on in the U.S., but trying to keep up with what's going on geopolitically and around the world, just not my cup of tea. So I tend to avoid energy stocks. I mean, for the long term, you've got some good ones like ExxonMobil and Chevron and so forth. But to try and trade them short term like I do other areas of the market, I've personally found it more difficult. So I tend to stay away. But just pointing out the technicals, anything above 87 at this point would look pretty strong in the near term for that group. Discretionary, talked about the IWM over here, up. There's your little cup and the pullback. Well, the discretionary group up looks to me like a cup. Do we get a pullback, or is this simply going to break out? Did we already get the pullback? We didn't quite fill the right side of the cup before we went down to the 20-day. But if you call that the cup and you have a slight downsloping line, we've already broken out. So there's a little bit of maybe I'm not quite sure what to label it, but I would just say discretionary is maybe a little bit on the just kind of in the middle, not really breakout. I wouldn't consider this a breakout, especially given that the volume was so light. So I'm thinking we're just up against key resistance right now on the XLY. So maybe a little confusing there. Let's see how, how over time when you have muddy water and then all of a sudden the mud starts disappearing and your water gets a little cleaner. That's kind of what I'm waiting for here with discretionary, just waiting for the muddy waters to clear a little bit and see whether or not we're truly in a breakout mode or if we're going to pull back. The one thing I really like here on discretionary is that we have gone down. We've tested that PPO center line, and now we're starting to rise off of it. So I'm seeing momentum starting to turn much more bullish. And so that means watch that rising 20-day EMA to the downside. If we do form a little bit of a handle, that's where I would suspect that the selling would stop. So watch that. Technology. Technology, you look at it and you say, well, been in this negative divergence for a while. And by literal definition, I would agree. But I kind of look at the strength in December versus November. See the higher highs there and see that lower PPO. That actually, to me, essentially played out. We didn't quite get a 50-day test, but we got really close. The PPO didn't get quite to the center line, but we got really close. And so I think that momentum back then is already, we've moved on from that. We've pulled back. We got the momentum almost completely squeezed out of the market. That's essentially what happens when you get down to the zero line, because if you know what the zero line means in the PPO, it means that your short-term and your long-term moving average are equal. One's not ahead of the other one. There's no momentum at that point. When your short-term moving average and your long-term moving average are exactly the same, there's no momentum. So, and if you look back, the PPO is always going up and down and up and down. It's like it resets. It's kind of like the VIX. People try to play the VIX for a trend. There's no real trend in the VIX. The VIX goes up and it comes right back down. It goes up and comes back down. It may stay elevated for a little while, but I see people using trend lines on the VIX, and generally that's not a very good idea, in my opinion. But anyway, here with the technology group, we have another negative divergence, slight one, but you can see that the February high versus January also produced a slightly lower PPO. Now it comes at a much lower rate or lower PPO. We're around the 2 level, whereas before we'd gotten over 3 or close to 3. So I don't see the momentum issue here being as great. And maybe, again, did we already have that 50-day test? Because that's what I look for to quote unquote reset the PPO and that negative divergence. I look for a 50-day test, and more specifically a center line test, because the center line test tells us that those moving averages are now back equal. And at that point, momentum's gone. So sometimes these negative divergence on the daily chart can set the market up for a long-term top, but other times it's just a temporary pullback. And it's quite possible that technology's done what it needed to do to get rid of that negative divergence. So here we go again. Do we break out? We got to get through about the 209 level to do so. I would be watching that area. A little bit of good news is that we saw autos rebound yesterday, up more than 3%. This has been a group that's been not only lagging the overall market, but it's also been holding back discretionary. This is a big part of the XLY. Tesla and Amazon are the 2 biggest holdings by far in the XLY. So if autos get going and Tesla gets going, that would probably be the final straw for a serious breakout on the XLY. But one thing I do like about the autos is that as we kept going down, and then we've had this little bit of bounce, look, the AD line actually took out the high that we saw back in December. So there's at least the possibility that there's been some accumulation during this most recent downtrend. And the reason that there would be accumulation is because the market sees prices going higher. That's why you would accumulate. So that AD line may be sending us a pretty good signal. Let's watch for confirmation. I really want to see the auto group get through that 750 area. That's where we got the big gap down. Came back up, tested that area. Now we're trying to hang on to the 20-day moving average. If we can move back up now and clear 750, I think that would be a really, really good start. Obviously, the 50-day moving average overhead is going to be the second issue to contend with. But those would be the two levels to watch, in my opinion, on the auto group, should we see more strength. The internet group weak yesterday, down 2.6%, but falling right back to about the 20-day moving average, just a couple points below it. The 20-day currently sitting at 38.76, and internet stocks finished at 38.70. So right at the 20-day, and if you look back, really ever since the beginning of this rally, maybe we went below the 20-day just a little bit there to open up December. But otherwise, since the end of October, once we've gotten through the 20-day, notice the 20-day has been sitting above the 50, and price action has been almost exclusively above the 20. That is an uptrend. That is what a bull market looks like right there. Price action trending above the 20 and the 20 trending above the 50. Been a great move on the internet stocks. Could they be pausing for a little bit? Yeah, they probably could. I wouldn't be surprised, though. I think they've got some really good leadership, especially from Meta. I wouldn't be surprised to see Meta make another push and send that internet group back to a new high. The specialty finance group, also weak yesterday, but my, what a run it's been in this group. So we have a bearish engulfing candlestick. We saw the volume spike up a little bit as well. But with that AD line looking strong and the price action, the PPO moving up, I suspect any selling we see will probably be contained by that rising 20-day moving average, which is at 594 and rising. So somewhere around the 595, 600 level, and we're at 610, 609 and change. So we're not talking about too much room to the downside before we catch some pretty good support. But specialty finance has been a good area. So when you go into when I see something like this, if this group gets back down to the 20, I would start looking in specialty finance. Now, one way you can do this, because I get this question a lot, it came up recently at Earnings Beats. One of our members wrote in. So I want to show you, if you get something like this, you say, well, how do I trade this? I can't trade this index. Is there an ETF? Well, I don't follow all the ETFs out there, so I'm not 100% sure if there's going to be one that tracks this index. There might be something that's similar. You might want to, if you find an ETF and you're wondering, okay, is this similar to the specialty finance? Pull both of them up and check the correlation at Stockcharts. That's the way I do it a lot of times. And if they're positively correlated almost all the time, then yes, I would consider that ETF to be something that you can use to track a particular index. But if you're looking for an individual stock, and that's usually what I'm using it for, if I find a group that I like, normally what I do is I'm going to look for some individual stocks that could benefit from a bounce in that particular index. So here's what you could do. You go into dashboard. You can go over to industry summary. I like table view, but go down to the financials and look for specialty finance. There it is. Now all I have to do is click on that group. And this gives me the stocks within the group. I can sort them by scooter, so I can look at the ones that have been moving the best. And you can see these are maybe some to consider. Might have to take a look at them and just see. You can scroll over the symbol to get an idea of what the charts look like. You can see Paysign right there. It's only a $3 stock. I usually don't trade small companies. I don't know. It's one of the ways that I kind of stay away from some risk. But others love to trade small companies, so it's really up to each individual. But you can kind of just go through and look to see which stocks maybe would be ones. This is one it's $2.50 stock, so I'm not going to do anything with it. But I like that pattern. I like that first. Well, let me just pull the chart up. So you got this high over here. You come down for a while, and now you're back up. Look at the volume over here on the right side of this. I don't know if I'd call it a cup, because here's your uptrend, and the cup is not supposed to come down more than 50% of the advance. And it certainly looks like It's come down more than 50%, but still doesn't mean that the overall psychology behind the move isn't there. I mean, you had an advance, you had a pullback, lighter volume, very light toward the bottom. And then on this move back to the upside, you can see the volume getting much heavier. So a breakout on a stock like this would very much interest me, except that it's $2.50. But that's the kind of thing that that's how I would go about looking from a specialty finance, a group that maybe looks good on a pullback to a certain level. Come in and take a look at the stocks. Many of the stocks are in the same group. You can look at Scooter. You can maybe just pull up the large cap, and you can see if you hit Scooter first and then you hit the capitalization, you will see not only the large caps here, but it's in order of Scooter. So now I can just look at maybe these four right here. These four would be of interest to me because they're showing relative strength. They're large cap. I mean, maybe you look at a couple, maybe the mid cap here, 78.3 is not bad. So maybe HTGC, let's see what that chart looks like. Yeah, it's trending higher, so we get a pullback. Something closer to 18 near that 20-day. That would be interesting. But let's see, what was the other one here? That one. This was actually one that I looked at for our portfolios the other day when we were doing our draft. Had a nice move with big earnings. It's pulled back. That 20-day moving average has been tested. You got gap support probably around 129. Haven't quite gotten down there, but maybe an intraday move below the 20-day near 129 would be interesting on the stock, especially given that its AD line is so strong. So that's how I just take, from one group and kind of look for stocks that could benefit from any kind of a pullback. I would see ARES as one that could. All right, moving on, 10-year Treasury yield. First of all, we did have one economic report out this morning so far, and that was the durable goods for January. It was not a good report, but what I can tell you is that the durable goods normally is very volatile. So looking at it from month to month, sometimes you see big blowout numbers one month, and then you see an absolutely horrific number the next month, and then it's another big number the following month. You probably, if I was going to follow this, which I don't follow it that closely, if I wanted to, I'd smooth it out. I'd be looking at it over maybe a 3 or 6 month moving average type of thing, just because they're so volatile and all over the place, and the market doesn't seem to react to it. So like this morning, new orders, consensus number, first of all, prior number for December had been 0. They revised that lower to minus 0.3. The consensus number for this current quarter was minus 4.5%, and it came in at minus 6.1%. And if we strip out transportation, we're expecting a rise of 0.2%, and it came in at minus 0.3%. Okay, and then I look at futures, and futures are up. So it's like there's not really, and that's the way it is for me. I don't see that there's a big correlation between what happens on this index and what happens in futures, and rightfully so, because again, the volatility in durable goods is all over the place. But that was one report. I think another report actually that did come out was the Case-Shiller Homes and the FHFA House Price Index, because they both come out at 9 a.m. when I started the show. Case-Shiller Home Price Index for December rose 0.2%, which was exactly as expected. And the FHFA House Price Index rose 0.1%, which is exactly what was expected. So no big shakes anywhere there among the economic reports. We do have consumer confidence coming out at 10. Tomorrow, we're going to get that second estimate of the GDP. And I think the estimate right now is for 3.3%. So we'll find out tomorrow whether or not it's been revised higher or lower than it was first reported and what's expected. But that'll be out tomorrow morning. Jobless claims, personal income, pending home sales out on Thursday. Friday, we got a couple manufacturing reports, consumer sentiment. Got some more Fed speak coming up later in the week. That could throw things, to the downside, but I think the market's already kind of reading through Fed Chief Powell. We've seen him waffle enough times at this point that I think the market doesn't care as much when he waffles. But as far as the 10-year Treasury yield goes, still trading above 420. So I think as long as we stay above 420, I think you have to consider this a short-term uptrend in yields. If we fall back below 420, back below the 20, then I would be looking more in terms of sideways consolidation, meaning that this is still your support, but now we have a different high. Instead of it being 420 as our resistance, now it would be up around 435 and be in this range maybe for a while. Wouldn't surprise me. I think eventually maybe we're going to break down below this 380 level. I've said before, I think we'll go back to 3.25, 350. I think there's an outside chance we see the twos, but I'm not counting on that. I think we move lower. Remember, this is a 10-year Treasury yield. This is not what tracks with the Fed. So if the Fed's saying they're going to be cutting rates for the next couple of years, that's short-term rates. That's Fed funds. 10-year Treasury yield doesn't exactly follow short-term rates. 10-year Treasury yield actually is more indicative of what the mortgage rates are doing. So you've got short-term and then you've got longer-term. So 10-year Treasury yield isn't necessarily like the Fed cuts. You're not always going to see the 10-year Treasury yield going down as a result. All right, moving on. S&P 500. So rolled over a little bit yesterday. Slight negative divergence, just like with the Nasdaq. Higher prices, lower PPO. Of course, we don't know how much higher we go on the S&P. What if we break out again? I can say that back at Market Vision 2024, back early January, the way I had the first quarter laying out was that I thought we might be able to get up to as high as 5,000 in January. We got over 4,900 by the end of January, didn't get to 5. And then I thought for the first quarter, I thought our high would be around 5,100. And we've hit it. And we are now in the second half of the first quarter when we typically don't see the same type of gains. So I'm pretty much going to stick with this. Maybe we go a little bit higher than 5,100. I don't know. Maybe we go to 5,200. But I do think that we have to lower our bar of expectations for the market when you go into the second half of any of the quarters other than the fourth quarter. Fourth quarter, second half, November 16th to December 31st is bullish. In fact, it's just as bullish as the first half of the quarter. But quarters 1, 2, and 3 have a distinct pattern. They run up pre-earnings, they run up during earnings, and then right about the middle part of the quarter, which would be February 15th, once earnings are starting to slow down, that's when we tend to struggle. Like I said, second half of February and then into March. That's historical behavior. That's not every year. That's not a guarantee. I don't talk in guarantees. I talk in risk. So you have to understand that the risk is higher, that we are not going to see the kind of gains that we saw in the first half of the first quarter. That's what history tells us. And on the Nasdaq, it's even more pronounced. I think on the S&P, I think we average like 12%, or we have annualized returns of like 12% in the first half of the first quarter. Second half of the first quarter, we have annualized returns, I think, around 4%. So it's just much less. That goes back to 1950. That accounts for a lot of trading days in the first quarter, going back 74 years. The Nasdaq, it's even more pronounced. On the Nasdaq, the first half of the first quarter, January 1 through February 15th, we have historically seen annualized returns over 30%. I think it's around 31% during the first half of this quarter. Second half, I think it's minus 0.11%, dating back to 1971, which is 53 years. So over 53 years, if you take just the second half of the first quarter, let's think about this for a second. So there are 8 halves, 8 quarterly halves. So if you've gone back 53 years, you can divide that by 8. And that is roughly 6.5 years worth of data. Just looking from February 15th to March 31st, you think, well, it's only a 45-day period, no big deal. Well, it's 45-day period of every year for 53 years, which is the equivalent of more than 6 years, more than 6.5 years of data. And it says we don't go anywhere. Imagine if I told you that from now until the year 2030, we'll be right about where we are right now. Would you think that's meaningful? You probably think it's meaningful. Wouldn't want my risk. I wouldn't want my money in the market. I'd go find a CD or something else somewhere. Treasury bonds, whatever, would beat zero. So if you think that's meaningful, then you ought to think that the second half of the first quarter is meaningful because it's the same time frame. 0% annualized returns on the Nasdaq since 1971, from February 16th to March 31st. So that's why we need to lower our expectations. And, from a perspective, just perspective, wouldn't it make sense to pull back a little bit after this rally? So it's okay if we pull back. You'll have all the bears jumping in, CNBC, Armageddon, whatever. But we could use a pullback. I mean, the Nasdaq, I wouldn't mind seeing 17,000 at some point over the next 6 weeks. We're at 18,000. That would spook a lot of people. We break below the 50-day moving average, just like we did back here. People be up in arms. Oh my gosh. Can't be happening. Market goes down sometimes. IWM. So this is the most bullish chart of the three, to be honest. It hasn't gone up as much, but you got a really nice bullish pattern here. And there's nothing wrong if we did see a sell-off in some of the large cap stocks, even if it's just a brief one and a mild one. It wouldn't surprise me at all to see that money flow rotate over into the small caps. Look at all these hollow candles over here. Look at the AD line. This is what happens to the AD line when you have a bunch of hollow candles, because it means that you're closing well above your open. And in the, most of these candles, we're either at our highs or at least well off our lows. And that's what drives the AD line. And that's also, if you talk about amateur hour being in the morning, I would much rather see buying in the afternoon than in the morning. Buying in the morning, gap ups and then buying until 11 and then selling off the rest of the day. That's what you typically will get during a bear market. During a bull market, it's very common to see morning weakness followed by afternoon strength. And that's what we've been seeing here. All we need is that breakout. 205, close above 205. We're going to open here in about 2 minutes. And right now, I believe, I'll give you the latest on the IWM. We're up about 0.9%, trading just below 203. So 202.91. So it's going to take us somewhere up in here at the open. I think if we follow suit like we've been doing in a recent past, maybe we see a little morning weakness. But pay attention in the afternoons, because if we see strength and the IWM makes that breakout above 205, we could see a really nice rally in the small cap area based on the fact that it's already broken. I mean, if we look at a weekly chart, I'm already seeing very bullish characteristics on the weekly chart. See how in previous periods when we've gone up and down, how we haven't been able to hold moving average support? That's a sideways consolidating market. That is just pure consolidation. When the moving averages don't do anything, that's your first clue that you're not trending anywhere. We're going above it, we're below it, above it, below it, above it, below it. Test it, above it, test it, back above, down, back below. Now we're testing, now we're through. Well, look at what's happened so far this time, which is different than these other times. We've pulled back and we're holding that 20-day moving average. And we have done that. We did do that. Where did I see? Oh, right here. So we went up through it, tested it, went up, tested the highs, never could get through, and then went down. This time we took out the highs. So that's step one. Step two, hold the 20-period moving average. We've done that so far. That's now up at 191, 192. If we continue to hold and we get a breakout, that would be a very bullish confirmation of a breakout. So I'm watching the IWM closely. I think 205 is a big level. Transports, sideways consolidation. We're still going in up and above these and below these moving averages. Look at the PPO sitting on the center line. That's the poster child of consolidation. All right, chart of the day. I want to get into some of these earnings. And how you trade them. It's 9:30, but I'm going to give you maybe a quick 5 to 6 minutes on this, how I look at earnings and how I would consider trading earnings. Now, there's a couple trades going into earnings reports. One is to hold into earnings. I always say that's the riskiest time of the quarter to hold an individual stock into its earnings report. Doesn't mean that I don't do it on occasion. I do. But the chart has to set up the way I like it. And some of you like that speculation. I get it. I mean, you can make a lot of money with the earnings. You can see some huge gaps to the upside. Just don't let that potential, winning trade cloud your, your risk profile, or not really profile, but you've still got to evaluate the risk, because just as easily as the stock might gap up 10 or 20%, it could gap down to 10 or 20%. So you can't just go in thinking how much money you're going to make. You need to go in and understand, if you're going to take that trade, how much money you can lose. And I have no idea going in. There's no way to say, well, it's not going to drop more than 10%. We don't know that. So you got to understand, you got return on the one side, but you got risk on the other. And you have to be willing to literally go to Vegas and put your money on the roulette wheel and say, do you want red or green or black or red? I guess it's black and red. Shows you how often I go to Vegas. I used to love to go, by the way, but haven't been in a while. But anyway, black or red, what are you putting your money on? Because that's essentially what you have going into earnings. Now, I do think there are some subtle signals that can tell you whether or not the report is going to be good. That doesn't necessarily mean great reaction. You might have a great report. Stock may still be down. In fact, I'm going to have one of those to show you in just a minute. So Trex, when I look at a stock going into earnings, this is the chart I look at, the chart style. I have my AD line. I have my price action. I have my price relative to peers. And then I have the peers relative to the S&P 500. And if all four of these lines are going up, I feel pretty good going into earnings. Again, doesn't mean I'm going to get the reaction I want, because we've been going up. A lot of it may already be priced in. Sometimes you have a buy on rumor, which this could be, and a sell on the news. Sometimes companies come out with such good news, they keep the gap up anyway. I'm going to give you an update here so you can take a look at this one. And there's your gap up this morning. Trex is up almost 5%. But this is the type of stock that I would consider owning, especially even if they come out with good numbers and the stock goes down. You can't help that. I mean, you just don't know when that's going to happen. But if they came out with good numbers and it gapped down, a lot of times there's a pretty good time to buy a stock like that on the gap down. Number one, you've got a company just beat revenue and earnings. So why is it gapping down in the first place? The second thing is, when it gaps down, everybody's selling at the open. Market makers are buying. So you're actually, if you were to get in on the open, you would be, basically taking a seat right alongside the market maker. And market makers make money more often than they lose money. So, and that's why most gaps will fill, because market makers are on the other side. If it's just a common gap and there's no volume, I don't really care about it. If it's a big gap with fundamental news and the volume is heavy, I care a lot about that gap. It makes a big difference which way it trades after the gap. So there's still, I don't know what's going to happen with Trex. I mean, we could see it absolutely explode to the upside after earnings, or we could see a gap fill, maybe even a trip all the way back down to the 20-day. You see crazy action with earnings. Volatility picks up. But I do love this AD line. I mean, that is about as strong an AD line as I have seen. I mean, it is just straight up almost every single day. And that's because for the month of February, we haven't seen a single day that's filled other than the first right here at the beginning of the month on February 5th. And even that day, we were well off the earlier lows. So when you got a strong AD line, what I would look for is weakness. If Trex were to fall back to 95 and then maybe to 91, I'd probably have two entries in play. I'd be looking at getting in around 95. And if it did fall through that gap and hit the 20-day, I'd probably get in a second time. All right. Now, here you have Workday. Workday looks, let me get, shoot. When I show this, it's going to give us the update, but I want to show you the relative strength. And so, by the way, this one gapped down. So if you buy it on the gap down, which was down at 292, the high was 304. from the gap down to the high, and we're only in the first 6 minutes of trading, that was $12 to the upside in 6 minutes. So everybody who sold at the open, market makers bought, and within minutes, market makers were up $12 on the stock. Now it's come back down. I actually think this stock maybe could hit mid 280s, maybe even back to 280 to test this breakout area, but it looks like we already tested that. I would say probably 285, but maybe outside chance 280. But this is a stock, when you look at it, it was at a 52-week high relative to software. Software throughout the year has been one of the best industry groups. So Workday has been one of the best stocks in one of the best industry groups. They beat their revenues. I didn't mark the numbers down, but they beat their revenues. They beat their earnings per share estimate, and the stock gaps down. So you have Trex, which gapped up 4%, and then you have Workday, which gapped down 292, and so that was $15 from 3. So that's about 5%. So both these companies were strong going into their earnings reports. Both beat top line, both beat bottom line. One gaps up 5%, the other gaps down 5%. Flip a coin. I don't know which one's going to do which. What I do know, though, is I still like both stocks. They're going to be on our strong earnings chart list, I can guarantee you, because they beat top and bottom line and their charts look great. There's probably, like I said, going to be volatility around earnings. I can't tell you where either one of these stocks are going to finish today, but you can probably count on some volatility. And, even a stock I looked at the other day with Palo Alto Networks. This thing gapped down. I can't remember if they missed anything. I thought they beat top and bottom line, but maybe they didn't. Anyway, this one's come rallying back big time. So if it did beat top and bottom line, and you're like, okay, this is just overdone. You can go back and you can look. There was a top there at 260, tops right in here at 260, top here at 260, and then broke out and never went back to 260 until after earnings. Then it filled to 260, and now it's coming right back up. Now, one thing I like to do, and I was going to look at this stock in particular today, and we're running over. And because I do these shows and I do so many other things at earnings beats, I usually miss out on individual trades. I'm really not nearly as active as I used to be, because I don't have time. It does take planning. It does take hard work. You just don't get lucky. But HIMS, one of the things I was looking for was to see whether or not we opened above that high, because I knew it was up and after hours. And so I always like to see if key resistance levels are cleared. That candle body was at 1230. It opened at $12.30 back on May the 8th. That was the high candle body on this 52-week chart. Today, we opened at 1233. So here the high was 1230. We went 3 cents above. That just tells me, it gives me a hint. Doesn't guarantee anything. But to me, opening above resistance tells me that the odds are greater, in my opinion, and in my experience, the odds are greater that is going to continue higher. So if it gaps up above and it comes down intraday, that is usually an opportunity. And I've had some of my best recent trades on this exact type of trade, where you gap up above, you get that sell off in the morning. Usually I like to get in later than this, though. Normally I'm not looking to get in the first 5 minutes. Normally, get a stock like this gaps up, maybe it comes all the way back down to 1050 or something by 11 a.m. And maybe this one will. Maybe it still will come down. Who knows? But at that point, that's when I start thinking about, okay, it gapped up. If it finishes back up at the high and I get an opportunity to get in during the day much lower, I could see maybe a 20% profit in a stock like this in a day. Now, you don't always catch those, and not easy to catch, but I've seen that plenty of times, and I've been in trades like that. So trading earnings, to me, there's a number of different things I look for. Number one, are you going to trade it going into earnings? What I would prefer going into earnings is a stock that has been leading its peers higher, relative strength is strong, price action's been strong, and then maybe even the last few weeks, maybe it's pulled back a little bit. I just feel like some of the risk has been let out of the stock. If you've pulled back and then expect to have that good report, we could easily gap back up above that recent high. And so sometimes when I get a pullback, I would consider going into a stock prior to its earnings release. Usually not a full position, though. Normally I'm going to cut the risk a little bit by my position sizing. Anyhow, a couple other real quick, we've gone over, but I wanted to show a couple other earnings I saw last night that I thought were pretty good. Cava, this is Cava Group. Now this one did not clear on the open. This is a good one to show. So here the top was 57.11. There was 56.99. Here we got up to 56.34 intraday. And what did I say over here? 57.11 was that high close. 57.11. Here we got as high as 56.03, but our open was 54.29. We have not made the breakout yet. So I think this one probably settles down from here. Probably. Maybe most likely. Before it goes through 57, I believe we'll probably see a 20-day test. That's the way I would look at it. And again, I'm just talking based on odds and just based on what I've experienced. EverQuote, huge gap up. This one clearly taking out all prior highs. But you've got market makers on the other side. Maybe at some point we'll get a pullback and a gap fill. I think it's going to depend on how we finish today. If this stock finishes, it opened at 2022. If it finishes at 22, 23, and next couple of days keeps going higher, and we see the volume, $1.5 million, $2 million, or even more, that's going to tell me today's open is probably in the future going to be my low, 2022. I would be looking at the top of gap support. If, however, we finish today with a candle like this, or maybe even a little bit red filled, we close below today's open, then I would be looking more toward a gap fill. So anyway, that's how I look at gaps. Maybe that'll help you. Maybe you look at it differently, which is fine. Technical analysis is very, very subjective. Some things are objective. I mean, price breaking out, I think, is pretty objective. But a lot of other things are very, very subjective as to where you see support, trend lines that you connect, looking at daily charts versus weekly. There's a lot of different things to consider. But anyway, let's maybe take a quick look, see what the major indices are doing intraday. So we've got the diamonds coming down. That opened lower to begin with. The spider opened up, now down a little bit. QQQ opened up, now down a little bit. I'm watching this level right in here on the Qs, 436. Had a couple intraday moves just below that level, which we did today. We go through that. The next key area on here would be around 433.5 to 434.5. And if that breaks, that's when you could see more selling, I think, in the QQQ and across the market. Then we'd be looking to see if we got any rotation. And then finally, the IWM. See if that's holding. I mean, we were up nicely up over 203 and over 203.50. Now we're back down below 203. Here's that morning weakness I talked about. I mean, we see it even here on the gap up. We pull back. Here in the morning, we pull back. Look, this was the low of the day at what, 10:45 in the morning? Low of the day on the 23rd was at 10 in the morning. Low of the day on the 26th was right at the opening bell. So, yeah, usually we see the lows form in the morning during uptrends, especially when that AD line is strong. So, buying in the mornings has been a great strategy on the IWM of late, probably this month, because we've been seeing all those hollow candles. So anyway, went on a lot longer than normal today, but I don't know, maybe I'm feeling a little spunky. But that's it. See what the VIX is doing here. VIX, just kind of flat, 1372, still down. But you can see mostly a mixed picture at this point with small caps leading so far. Everybody have a great day. Check out our service. Try a 30-day free trial right here. And then you can join us for our live trading room tomorrow at 10 a.m. If you've liked this last 10 or 15 minutes talking about earnings and how I trade, this is a lot of what goes into our trading room, talking about the different chart lists and how we can use our chart lists that we've organized to find really good trades really quickly. But anyway, check that out. Start your no-cost 30-day trial today, and you'll be able to come to the next 5 live trading rooms every Wednesday, 10 a.m. So anyway, love to see you there. Happy trading, everybody. Hopefully see you tomorrow. Take care.